On the company news front, we've had life insurance and healthcare company MMI Holdings having reported its first half results, showing a 16% increase in core headline earnings to 94 cents per share. And earlier today, I caught up with the CEO of the company, Nicolaas Kruger.
So we're very comfortable with the set of results. I think a core headline earnings increase of 16% is certainly ahead of the longer-term targets. I think if we drill into that number, in fact, and only look at the operating divisions, the increase there was actually 39% if you look at the average profit growth of our operating entities. But then on the shareholder capital, there were some once-off returns in the prior year. So if you add that, then you get to the 16%, which is still a very credible number.
Also a credible number is the kind of increase you've seen on the value of new businesses. That's up 18% to 340 million rand. What's driving the momentum there? And were you surprised at the kind of increase you saw on that front?
Yes, I think you're right on that one. It really came in ahead of expectations of the market. And we're very comfortable with an 18% increase in the current environment. Clearly the good performance of the stock exchange, means that there is more money available, especially the more high net worth individuals often, shift some of their investments and so forth. So to some extent that, boosts sales and especially single premium sales. But on the other hand, many consumers are still under pressure. So what groups like us have to do, we really have to become very, very client-centric and really make sure that we meet the needs of the clients and we don't push products. And if we really meet the needs in the various segments and really understand those needs very well, it is possible to achieve growth like that.
Let's unpack that a little further. I mean, what needs are you seeing needing to be addressed by yourselves, and what shifts in product offering are you having to bring through in order to cater to those needs?
Yeah, I think what we try to do is we try to have a very wide range of products available in the various market segments, and we actually encourage each of our 6 divisions to be very, very close to the needs of each market. So it differs between the various segments, but what we've seen sort of at the lower end of the market, the real need for appropriate risk cover or funeral solutions, is really there, and one really has to deliver on that need. What we've also seen at the higher end of the market, a shift more towards savings product. Risk products still important, but lump sum savings business, even more needed at this point in time. So it differs between the various segments. And what we do as a group, because we've got a very comprehensive offering across various segments, also 12 countries in Africa, we need to have the solution that meet the needs in the specific circumstances.
Not only a solution that caters to those needs, but a solution at the right price. To what extent are your margins being impacted as you reap in this new business?
Yeah, in fact, what we're also very pleased with is that we've been able to increase the margins from a group perspective from 1.9% to 2%. So in difficult trading conditions, we've been able to marginally increase the margin. Clearly, the market is very competitive. As you know, there are quite a few players in South Africa and even slowly also entering Africa. So it's a balancing act, but we really don't want to sacrifice margin just for the sake of volumes. At the end of the day, we need to look at the returns to shareholders as well.
To what extent do you anticipate that competitive landscape getting a little bit more aggressive moving forward? Because last week we had the budget speech being delivered by Finance Minister Pravin Gordhan, and he highlighted the need, first of all, for tax-preferred saving products on the one hand, and then also widening the ambit for who can actually put these products to the market. And that, one would assume, changing the game and that operating landscape quite significantly.
Yeah, I think you make a very good point. In our strategic plans, we assume that there will be non-traditional players entering our space. What you'll start seeing is a bit of a blurring of the boundaries between the various financial services companies. Banks starting to offer some products that insurers have traditionally offered, and vice versa. It's for that reason that we really need to look at diversification initiatives as well. From a geographical perspective, say in Africa as an example, to enter markets where the competition is a little bit less, or product lines where we are underrepresented, like for example general insurance is a product line where our market share is less than 1%. So clearly, there's a lot of runway left there. So, you're right, it's going to be a highly contested market.
That's one assumes where your merger benefits would come into play, because as you explore these new business avenues, you've got to keep that cost line very much in focus as well. Let's run through the kind of cost benefits you're managing to already derive from the merger that you've seen.
Yes, Alishia, I think you make a very good point there. And in fact, that was one of the strategic rationales for the merger between Momentum and Metropolitan. You need to really get significant scale to become more competitive. We've already extracted sustainable cost savings of 256 million rands per annum through the merger, and we are well on track to ultimately achieve 500 million rands savings. Now that's a combination of factors. It's through natural attrition on staff, it's through integration of IT systems and processes so that you can close down some old systems and save the licensing fees, and it's also just to avoid duplication, even to just look optimally at where your branch office infrastructure is, your rent agreements, those kind of things. So it's really a comprehensive look at efficiencies across the group.
When you're looking at those efficiencies, let's bring it down to your employee base. I mean, there was a moratorium placed on retrenchments for 2 years. How far along are we on that front? And should we be expecting to see job cuts coming through from your end?
Yeah, in fact, you're right. There was a 2-year moratorium which ended in December 2012. But we've been able to manage the staff reduction where we required reduction mainly through natural attrition. And in fact, that end of that moratorium ended up being a total non-event. We created a staff redeployment center where we put people where there are duplications in, and we try to redeploy them elsewhere in the group. And we've been able to redeploy many of them and then achieve the reductions that we required to achieve. So in fact, we had a handful of people in that redeployment center in December, so it was a total non-event.
So in terms of the strategic fit that you've managed to derive from the Metropolitan Momentum tie-up, pretty much successful in your books, also
Yes.
from a cultural perspective?
Yes. Yeah, I think, we're a little bit more than 2 years into the transaction now, and especially with the current set of results, I think we're very strongly giving the signal that the merger is starting to work. And in fact, we're now starting to focus more strategically on growth and really less on integration, because it's almost really just some system integrations that still have to happen. So from a strategic perspective, it's made the group much more competitive and much stronger than any of Momentum and Metropolitan could have been on their own.
So let's take a look at that growth strategy moving forward. As you say, a shift from integration to growth initiatives, and we're looking at expansion coming through in a big way on the continent, 500 million rand being invested, but in the 12 African countries you already have a presence in. So
Yes.
Take us through that rationale.
Yes, yeah. Geographical diversification is one of our growth strategies. So we have a footprint in 12 countries in Africa, and we'd like to make further investments in those businesses or to acquire other businesses in those countries, because we really want to expand the product offerings in the countries so that we have a broader range of products to meet the needs of clients in those markets. We've set aside 500 million rands. We know it will take some time to invest that, because there are many opportunities, but often not at the right price. Because many of the opportunities are not listed companies and more unlisted. So we'll work very carefully with our shareholders' money, but we really would try to invest that, say, over the next 2 to 3 years.
That was CEO of MMI, Nicolaas Kruger.